This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz on Bloomberg Radio.
This was Operation Say Nothing, where you basically repeat data dependent over and over again, but didn't say which data. And then you basically had a little bit for everybody, basically saying they are concerned about inflation, but recognizing that inflation has come in somewhat. This was Operation Do No Harm and say nothing and get out of there as quickly as possible, which he just did.
Highly repetitive, sometimes tedious.
Yes.
In the bond market, yields were higher going into this decision, lower following it. The two-year yield is down, Tom, by about 3 or 4 basis points in the bond market right now. TK, 483.91.
Some yield moves. It's good to see Gina Smilik of the New York Times pulling the Barbie movie here to give us the spirit of the American economy. January 31, 2024. Is he going to have a Lagarde-like press conference first of the year for the Fed, like tomorrow's Lagarde press conference if he gets a GDP slowdown, as we heard Bob Michael and Andrew Hollenhorst talk about? I'm fascinated about the luxury he has right now of a buoyant American economy. And if that drifts away, I'm not predicting that, but if that drifts away, John, is it Lagarde-like in January?
He is predicting it won't drift away.
Yes, very much.
The Fed staff are saying no recession in their forecast. Okay. Germany is living one currently. On the balance of risks around the economy, take a listen to what the Fed chairman had to say.
It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not. But as our stances become more restrictive and inflation moderates, we do increasingly face that risk.
If you asked that question 12 months ago, the answer was obvious. What's the biggest risk right now? Doing too much, doing too little? They would have told you straight off the bat. The biggest risk right now is doing too little. We need to hike 50, go even more than that. TK, the further along you get into this journey of Chairman Powell and co., the less obvious the answer to that becomes. We're at that point right now.
We're post-pandemic without a theory. And if you're at Berkeley taking your PhD, maybe you can figure out a theory post-pandemic, but I don't see it. William Dudley joins us now. He's a former New York Fed president, has the immense advantages of years with Ed McKelvey doing market economics at Goldman Sachs. We're thrilled that Dr. Dudley could join us this morning. Bill, we got to wake everybody up after a summer press conference. You ancient past, Bill, this is 20, 30 days ago. The great U.S. Treasury bond rout is far from over. What I have not heard today is a discussion about higher interest rates. What is your belief that we could see higher interest rates?
Well, I think the Chair Powell made it very clear in the press conference that he doesn't see the need to go that much further. The very fact that it's sort of meeting now tells you that he thinks that, maybe there's one more rate hike, maybe there's no more rate hikes as we go forward. But that's a very different story than what does that mean for the bond market? Because bond yields are low relative to short-term interest rates. I think there's a number of reasons why bond yields could move higher. Number one, inflation is probably not going to average 2% over the next 10 years. It's probably going to average a bit higher because the Fed has an asymmetric regime where when they miss inflation to the downside, they try to offset that with misses to the upside, but not the other way around. Also, if you look at the savings investment balance, it's not as favorable now as it was before because we have a lot more investment programs motivated by Biden administration policies. And the savings pool is also affected by the very large fiscal imbalances that the U.S. is likely to run for many, many, many years. So that implies that perhaps the neutral federal funds rate consistent with neutral monetary policy, a little bit higher than in the past. And then lastly, the risks are two-sided now for the bond market. Before it was all about, I could hold bonds, and if we ended up in a recession and the Fed got stuck at the zero lower bound, the bond market would protect me. But now we're a long way from the zero lower bound. So the risk of getting stuck at the zero lower bound seems very diminished at this point. And the risk of inflation being sticky, I think, remains very relevant to the bond market.
Bill, we had an article at Bloomberg this week, folks. John Authors and Isabel Lee reported on the strategy world and how absolutely it's brutal has been for Wall Street strategists. Bill Dudley lived this at Goldman Sachs years ago. How clear is the Dudley crystal ball right now, Bill? What's the vision you've got? Are you making it up as you go?
Well, I'm a lot less clear now than I was, say, a year and a half ago. I mean, at that point, it was very clear that the Fed was way behind the curve in terms of the need to tighten monetary policy. They were going to have to go to restrictive, and they were going to have to move fast to get there to keep inflation from getting totally out of control. Now they're at a restrictive setting, and so the question is, how high do they have to go to be sufficiently restrictive, and how long do they have to stay there? And I think they've been the economic news has been breaking in a favorable direction in the sense that they're getting quite a bit of disinflation without actually affecting the growth rate very much, or without actually putting a lot of people out of work. I mean, the fact that inflation's come down and the unemployment rate's still 3.6% is really good news from the Fed's perspective. But my own view is, I'm still where I was before. I think the Fed's going to have to be, tighter for longer, and I think they're going to probably emphasize the longer piece. If you look at their forecasts, they don't see inflation getting back to 2% until 2025. So they think the process still has a long way to go, and I agree with them.
Bill, how important do you think it is that essentially this is a Fed no longer giving forward guidance?
Well, I think that's sort of appropriate. If you've gotten in the vicinity of where you think you need to be, and you're uncertain about what's next because you don't know if you've done enough, you don't know much about the long and variable lags of monetary policy, you don't know how financial conditions are going to react to what you say and what you do. I think at that point you don't really want to give forward guidance because the forward guidance is probably going to be misleading as opposed to illuminating. So I think it makes sense for them to talk about going meeting to meeting. The only thing I was a little surprised today was that there wasn't much talk about the long and variable lags of monetary policy and the need to slow down the tightening, the rate of the tightening process. Powell very clearly put the September meeting back on the table. And I was a little surprised by that because the last meeting was all about the need to slow down and go at a slower pace. And now I find out today that September is a live meeting.
Well, and he was actually pretty blunt on that. Someone asked him specifically, how does this jibe with what you said at the previous meeting? And he basically was like, that's all I'm going to say about that. I'm not going to continue. I'm wondering whether you think it's actually more confusing that there wasn't dissent at a time where there clearly is a range of opinions. And we have a Fed chair just reading the same thing over and over again in response to everyone's questions.
Well, the lack of dissent just means that people are pretty comfortable with the general trajectory of where monetary policy is today, and they're happy about the fact that inflation is coming down, and they're happy about the fact that it's coming down without actually having to really, push up the unemployment rate a lot, at least at this point. I think what's the problem that Powell has created for himself is what do you actually do in September? So in September, you're going to have a couple things. If you decide not to hike, what are you going to show in the summary of economic projection? Are you going to show further rate hikes? If you do show further rate hikes, it's going to raise the question of why didn't you do it in September, just like what we saw at the last meeting. And if you do hike, then the question is, okay, well, why are you going so much quicker now? And do you show further rate hikes in the summary of economic projections after a September rate hike? So I think he's made it very awkward for himself in terms of tying the projections of what's going to happen in the future to what they actually decide to do in September or decide not to do in September in terms of keeping rates unchanged.
Bill,
so
I
think they've created a bit of confusion. I think it would have been better to stick to the story of monetary policy, long and variable lags. At this point, we're close to where we think we need to be. Therefore, we're going to go much more slowly. But he definitely put September back on the table. I mean, he basically talked about the fact that we have two more employment reports until September. We have two more CPI reports before September. So he put the September meeting back on the table more than I would have thought he would have done, given that he talked about the need to go more slowly because of long and variable lags. So I found that a little bit confusing.
Some people frustrated about this September conversation, Bill. I tried to jump in to end it, but we can carry it on if you want. Barry Knapp wrote in and he said this: questions about whether they hike in September were inane. He went on to say the press conference went poorly, given no questions about fiscal policy working at cross purposes with monetary policy, nor any questions about the deep curve inversion and impact on small banks and the supply of credit. Bill, can we pick up on the first piece just briefly? Whether fiscal policy right now is working at cross purposes with monetary policy. Do you think it is?
Well, I don't think fiscal policy is stimulative right now in the sense of the fiscal impulse, but we have very large chronic budget deficits, and those budget deficits are going to continue as far as the eye can see. So the way that plays out is it means that the demand on the pool of savings is higher because the government is taking down so much of this supply of savings. And over the next year, we're going to see a lot more Treasury supply, right? Now that the debt limit crisis is behind us, the Treasury is going to be ramping up their borrowing needs very, very substantially. And the Federal Reserve is going to continue to sell. Is going to continue to let $900 billion a year of treasuries and mortgage securities throughout. So there's made a tremendous amount of supply, and I think that's going to weigh on the bond market a bit.
Bill, the hallmark of your work at Goldman Sachs ages ago was an optimism about the American economics experiment. The most memorable moment today was Janice Smialek of the New York Times folding in the Barbie movie into a discussion with the chairman of the Federal Reserve about the resiliency of the American economy. The smart guys like you, everybody assembled in the room, everybody in the economics racket, do we just get wrong the resiliency of America?
Well, I think that we have gotten wrong the resiliency of the U.S. consumer. And I think what's driving it is the fact that during the pandemic, there were large fiscal transfers from the federal government to the household sector. And the household sector basically did three things with it. So, about a third of it was spent, about a third of it was used to pay down debt, and about a third of it was saved. And so coming out of the pandemic, the household balance sheets were in much better shape than they typically are late in the cycle. And I think that's why the U.S. consumer has been pretty resilient. I mean, I think the point that Gina was making was just that, going to Barbie in a theater is a perfect example of discretionary discretionary consumption. People can decide to do that or not decide to do it. It's not sort of a core necessity. And so the fact that the box office for Barbie and Oppenheimer were so good was sort of evidence from her perspective that the consumer still got some life in them.
It's a surveillance movie review right there. You got to ask him, did he go? You got to ask him.
Getting Bill Dudley and on Barbie. Tom, if you want to know, you can find out. Bill, did you watch it over the weekend?
No, I went to Mission Impossible. I haven't gone to Barbie or Oppenheimer. That's on my plans, though.
That's in the pipeline.
There we go.
Discretionary spend.
We just learned more there than we did in the press conference.
In the next weekend. Bill, thank you, sir. As always, Bill Dudley, incredibly insightful, lived it at the Federal Reserve as the New York Fed president. If you are just tuning in, welcome to the program this afternoon. Good afternoon to you all. The Federal Reserve hiking interest rates 25 basis points. The Federal Reserve chair saying that he believes monetary policy is restrictive. There was a moment in this news conference when Mike McKee, our good friend and colleague down in Washington, D.C., asked about that. I'm pleased to say that Mike McKee joins us now. Mike, the evidence that policy is restrictive, can you point to it?
Well, he's pointing to the fact that inflation has come down and that the Fed funds rate is now above the CPI in all cases, in both core and headline, and that real interest rates are starting to rise above zero. So they do see some restriction on the economy. But I think one of the key things he said was in his answer to me when he said policy has not been restrictive enough long enough. Now, he doesn't want to put a time frame or a actual number on what restrictive is, but clearly they could be there. They just have to leave it there longer. This was a man who wanted to basically keep his options open and not get tied down to anything at this point.
Mike, what does this 25 basis point move do to our listeners and viewers? I get, and this was alluded to by a number of our guests, big impact a year ago, 2 years ago. What's the impact today of this lift for housing, for food, for the day-to-day life that we have?
Well, it's probably not going to have much of an impact overall in a 25 basis point sense. It's the cumulative amount of tightening that's been done. That's what Jay Powell has been referring to over the last year and a half, where they've gone 550 basis points. Now, what you're looking at is decisions made on interest rates over a period of time. You don't buy a house every day. You don't buy a car every day. You don't spend money investing in a new factory every day. So it does take time for that to work its way into the economy. They don't know how restrictive they have to be. Clearly, they haven't been restrictive enough in the housing sense because home prices have still been rising. But overall, they're getting close to that area. And I don't think that the average American is going to notice really anything different about this 25 basis point move.
Mike, every time the Fed has a meeting, you sit there, you listen to the tenor, the potential snafus, the way that people ask questions. Today you heard a very repetitive, very stick to the script Jay Powell. There was no forward guidance. When was the last time this Federal Reserve gave no forward guidance about what they were planning to do or how they even were thinking about the data that's coming in?
Well, it's been quite some time. The idea today, and I said this before the meeting, was that come in, make as little news as possible. They were locked into raising rates because the market had decided that's what they were going to do. And so the Fed went ahead and did that. And beyond that, they tried basically to leave their options open. Jay Powell was very scripted, as you heard. He did sound more relaxed than he did at the last meeting or the last couple of meetings. So from that standpoint, Lisa, you could say maybe the vibe was they're getting close to the end. And I'm not sure at this point that they would raise rates again. But they don't want the markets to walk away from this thinking that they're going to do one thing or another. So they tried not to really give any guidance.
We're covering vibes of news conferences now with Mike McKee. Mike, thank you, sir, down in Washington, D.C. Appreciate it, as always. Here's the runway, the calendar for you. September 20th. The next Federal Reserve decision, Jackson Hole, of course, in between this meeting and the next meeting. For the data, August 4th for payrolls, August 10th for CPI, September 1st for payrolls, September 13th for CPI. So, TK, two of each, CPI and payrolls, going into the next Fed meeting. And you can take away from this meeting, this news conference, whatever you want. That conversation can change very quickly based on two prints of CPI and two prints from payrolls.
Lisa nailed it. She said it's just completely data dependent. I'm going back to that. I don't think there's any theory involved here. I don't think there's any textbooks. That conversation we had before the press conference was just absolutely brilliant on the ambiguities of the moment. Right now, with clarity, because he has to manage money, Jeffrey Rosenberg joins us, portfolio manager of BlackRock's systematic multi-strategy fund. Jeff, my deepest sympathies. You have to have a conviction, a belief forward. What is your conviction now, given the ambiguities we witnessed today? I think we have a little bit of silence here.
They've got to turn his microphone up, TK.
There.
You know,
I don't, you know.
Jeff put it on mute.
They're on mute.
Jeff's got to unmute himself.
But
it's
the
like a Zoom
ambiguities
call
here,
gone bad.
You know, the ambiguities here are important. And John,
Brammo, you know that's like when you're in the team meeting and Lisa starts throwing stuff at the screen. It's like, Brammo, you're on mute.
I'm going away tomorrow.
Listen to me.
You know,
And I start like pounding, and then excuse me.
I'm going away
Pass the tea.
tomorrow. And you guys are running the show. I'm going deep to the Northeast. I'm going away for months. It's going to be like a sabbatical.
You're taking a month off.
Taking a month off.
That means 2 days.
Yeah. And you guys have the former vice chairman of the Fed and the arch question to Vice Chairman Clarett, I believe, scheduled tomorrow in Bloomberg Surveillance in the mornings. Check it out, folks. And I'm John, I'm sorry. The arch question here is Clarett is saying we're not going back to 2%. We're not going back to 2%. Nobody, and Powell's not talking about it. I don't think anybody else really is. Clarett is out front on that.
I'm with you. The standout call from former Vice Chair Rich Clarett together with PIMCO came out in the Secular Outlook a couple of months ago. And ultimately, it's this underlying belief that they will tolerate higher, above target inflation of 2 point something. You got some indication of that, just a hint of it, when he talks about we're not going to hike until we get to 2%. That's ridiculous. And also, by the way, we don't think we're going to get to 2% until 2025. And within that, I think there is a message, Brammo, that they are willing to tolerate 2 point something because they're willing to tolerate above target inflation from here all the way out to 2025 if the Fed chair is correct.
You pick up a really interesting point because it highlights the uncertainty around long and variable lags. He's saying that if we wait until inflation gets down to 2%, we will have necessarily gone too far. Okay, well then how long do you have to wait before you understand what the ramifications of what you hiked? Is this a concession that you're willing to go to 2.5%? And that is really what people are trying to parse through. Basically, people are shrugging off, viewing this as a non-meeting. That's my view.
We haven't talked about this enough, though, and I think Jean Bavin of BlackRock, congratulations, by the way, for bringing this up repeatedly. What's the appropriate time horizon, the appropriate period to bring inflation back towards 2%? What is it? So one man's tolerance of above target inflation is another man saying, well, actually, we just need longer. And if he says 2025, isn't that just him saying, like, this is going to take a while and I don't want to crush the economy to get there sooner?
Well, I think that that's a great point. And I think the Fed said that they're willing to be patient but persistent. At that point, the issue is, will it become a self-fulfilling prophecy at some point?
Exactly.
If inflation becomes
Is there a
higher?
window? That's what you're getting at.
Yes, thank you. I appreciate that. That's helpful.
Well, it's a long day. I feel the way, you can fill in my sentences. You can fill in my sentences as well. I need it sometimes too, Bramo. Is there a window where they need to address this before it becomes embedded?
Right.
You've seen what happened with UPS and what almost happened with Teamsters and the strikes. What are we talking about here? 5% wage hikes? They're not going to be alone, are they?
No, and we're already seeing that pretty much across the board. And people talk about the tight labor market, but that changes the scenario in this profound way. This is the issue that a lot of people are looking at. And yet you're seeing that divide, whether it's Bob Michael or whether it's Jim Bianco.
You see the divide, and the wage thing is critical because a lot of people, they don't parse out unemployment rate. They don't parse out this, that, and the other thing. They are only and singularly looking at wage inflation. Through all this debate, if folks say, what's this meeting like versus the other 10 meetings we had? And I'm going to go to the great observation of Neil Dutta that we finally have a legitimate real wage in this country. And that changes the emotion, the behavior of people, like the bombshell from Drew Mattis earlier this week, really pushing against the gloom we heard from our guest, where he says you got a legitimate real GDP forward. Part of that, John, is a legitimate wage growth, which I don't think is within the debate right now. Inflation worry. We're worried.
Inflation worry.
We're worried.
I'm not worried if I'm getting a pay rise. I let
No,
people
we aren't.
worry about
No,
that.
no,
I
we
think,
aren't.
I've always found it weird when the economists say, this is uncomfortable. Wages are too high. And like everyone else is just like, there's nothing uncomfortable about this. That's what I want to happen at year end. I want a pay rise.
And we heard Jay Powell really speak to that.
Yeah.
He basically said, we want this. It's a good thing that wages are going up faster than inflation. And yet, is it, if that's the goal, to get down to 2%? This is a conundrum. And he tried to parse it through by actually saying nothing.
Elisa, you and I will try and say something tomorrow morning. We'll be here alone without
Yes.
TK. I think tomorrow there's going to be a conversation about something Mike McKee talked about in the news conference. What's restrictive? And what evidence is there that we are restrictive right now? This is what the chairman said. The FOMC believes monetary policy is restrictive. He did acknowledge that it's not restrictive enough for long enough, so they need to hold it here for some time. But ultimately, if you look at the real Fed funds rate, it's at a meaningfully positive level. Okay, well, let's look around. What evidence is there of that right now? And I would go one step further. What evidence is there that the disinflation we have seen so far is a consequence of the tightening they've delivered if they believe there are these exceptionally long and variable lags? And I would go to what Neil Dutta said at RenMac during this news conference, and I'll read out what he sent to me privately, but he's happy for me to share it with you all. He said the Fed remains wedded to the long and variable lags hypothesis. After 18 months, we've seen home prices accelerate, stock prices accelerate, auto sales accelerate, and layoffs sink. Long and variable lags is a concept that might be outliving its usefulness. Now, for the same people looking at the same evidence, you can have one individual, Bramo, that turns around to you and says, I think the long and variable lags are a whole lot longer. And someone else can make a different case with the same data and say, you know what, I think they're a whole lot shorter. They just haven't had any effect yet.
And anyone who's looking to the Fed for guidance, forget about it, because
Sure.
they're not going to give you any. And basically what I heard was a chair moving the goalposts, saying, okay, it might be restrictive, but it hasn't been restrictive for long enough. So is this a new criteria that it has to be long enough, that you put that x-axis long enough, and then that will take place? They don't know. So how do they communicate? We don't know. We're experimenting. We're going to look at things.
I think out of this conversation, and this is Ed Hyman, Evercore ISI, and I thought Michael Darda of Roth MKM was just brilliant today on this. There's an entire monetary or money side to this, including something no one talks about anymore, which is M2. I mean, if I was down there with Powell
Money
asking
supply.
a question, I'd say to Chairman, your PhDs tell you at the Fed that M2 doesn't matter anymore, velocity doesn't matter. Europe just announced a crater in loan demand with a slowdown there as well. What's the viscosity right now of the American system? Bob Michael's here. I saw him. He's on his phone doing commercial real estate workouts for Jamie Dimon while he's sitting on set in commercial.
Don't start rumours.
Good morning, Bob. Thanks for being with us.
Bob was fantastic, by the way.
Yeah.
You've teed up Europe quite nicely because
I'm
tomorrow
trying.
we shift away
Maybe
from
I
the
should
Federal
cancel
Reserve
my trip.
to cover the ECB.
It's a sabbatical, but I should, Madame Lagarde would like me to be here.
The European Central Bank decision is tomorrow, and it's worth repeating that Germany is in recession. The data is absolutely dreadful, and inflation, Lisa, is still sticky.
And this is the fear. What happens if this ends up being a similar story in the U.S. if inflation reaccelerates and growth slows down? We didn't hear that from Fed Chair Jay Powell. His base case is we avoid a recession and we end up bringing down inflation to 2%. The Goldilocks, he's leaning into that. And yet, yes. I don't think he's
leading into Goldilocks. I think he's worried about Bill Dudley's outlook.
Right.
He's just they don't want to make a mistake on the upside. They do not want to cut before they're certain. That's the emotion of the discussion.
I asked the question, Tom, earlier, whether the biggest risk right now was cutting too soon or holding too long. And I think
John,
I'm with you.
The biggest
Fed is
risk,
where you are.
if I missed the damn Gulf Stream at Teterboro.
Never mind. I saw him checking the train times.
Well, I think
during the news conference.
I think Jay Powell was checking the train schedule at the same time.
He wanted out too.
See ya.
We need out as well. You probably want rid of us.
This is the Bloomberg Surveillance Podcast. Thanks for listening. Join us live weekdays from 7 to 10 a.m. Eastern on Bloomberg Radio and on Bloomberg Television each day from 6 to 9 a.m. for insight from the best in economics, finance, investment, and international relations. And subscribe to the Surveillance Podcast on Apple Podcasts, SoundCloud, Bloomberg.com, and of course, on the terminal. I'm Tom Keene, and this is Bloomberg.